Welcome back. This is the last video, part 4 of the Capital Structure Puzzle by Myers, 1984. I'm going to talk about 5 facts and 3 observations which Myers makes in his paper, and plus I'm going to talk about the contribution I think Myers makes in this paper, that is the modified pecking order theory. As a brief reminder before we go on, let's talk about the heavyweight champions of the finance literature, which are very much what this paper is about. It's a comparison, it is a fight between these two titans, these two uh, colossi. So on the left side, we have the static trade-off theory. Usually, in these theories, firms are viewed as setting a target debt to value ratio, in which you are balancing uh, the value of the firm uh, against some tax shield and some costs, perhaps. You are trying to maximize the value of your firm by uh, usually incurring more debt so that you reduce the amount of taxes you must pay. On the right side, we've got pecking order theory. Uh, Firms prefer internal financing to external, and when they must use external, they will prefer debt to equity. And there is a whole list of reasons which we discussed in the previous videos um, as to why this actually happens. All right, so let's go to these 5 facts. These are, as you see, uh, preference of internal versus external equity. Uh, These are timing of security issues, borrowing. You can read them on the screen yourself. What's important to note is that these are just 5 facts which Myers says these are the things we know in financing behavior, and things that are sort of like he has tried to make sense of in light of both static trade-off theories and pecking order theory. First one, internal versus external equity. We've seen that aggregate investment outlays are predominantly financed by debt issues and internally generated funds. New stock issues play a relatively small part. Um, in This is essentially the uh, pecking order theory, but it's also reflected in a modified static trade-off theory. Second point, timing of security issues. This refers to firms trying to time their stock issues when their security price are priced high. They try to seek, if they try to seek external finance, that is. But when they do, they try to always issue stock rather than debt after stock prices have risen rather than fallen. Um, the third point, borrowing against intangibles and growth opportunities, is essentially firms holding valuable intangible assets or growth opportunities tend to borrow less than firms mostly withholding uh, tangible assets. We've seen this, I believe, 2 videos ago. All right. The fourth fact that Myers observes is exchange offers. Now, um, in exchange offers, what's essentially happened is that when stock prices rise, on average, when firm offers to exchange debt for equity, and when they fall, they tend to exchange equity for debt. This could be explained through several ways. It may be just a tax effect. If most firms' debt ratio are below their optimal ratios, that is, and if corporate interest tax shields have significant positive value, the debts for equity exchanges would tend to move closer to optimal capital structure. Equity debt swaps would tend to move them further away. Um, Finally, issue or repurchase of shares. This is no surprise given the fourth one we had just talked about. Stock prices tend to fall when firms announce a stock issue. and stock prices inversely tend to rise on average when a stock repurchase is announced. This was confirmed in several studies. Kowar, Axworth and Mullins, Dan and Mickelson, and Vermaelen, and D'Angelo and Rice. This is hard to explain through static trade-off, except as an information effect in which stock issues or retirement signal change in a firm's target debt ratio. Myers has already talked about this. Now, these were the 5 facts, and now we're going to go into 3 observations which Myers makes, which do not quite make the cut as facts, but are still interesting enough perhaps to research more on, and things he believes have some importance. I'm not going to go in depth. I'm just going to list them. So, first one is target debt ratios. The existence of target debt ratios, that is. Firms do seem to adjust to a target debt to value ratio as stipulated by the static trade-off theory, but empirically the evidence is not very high. This is one of our main results, which I discussed in the first video. The empirical data doesn't fit the model. The model doesn't fit the empirical data very well. Risk, what do I mean by risk? I simply mean that risky firms tend to borrow less, ceteris paribus. Finally, taxes. The problem here is that there is yet a study to be produced that tax status has predictable, measurable effects on debt policy. What I mean is that there is no study there was no study up until 1984 that showed how tax status, how that has predictable and measurable effects on debt policy. All right. In summary, the modified pecking order theory by Myers and Maslov explains these 4 things. 1, firms have good reasons to avoid having to finance real investment by issuing common stock or other risky securities, because they do not want to run the risk of falling between either passing a positive net present value project or issuing stock at price which the managers think are too low. The target dividend ratio, firms seem to set some sort of dividend payout ratio so that the normal rates of equity and investment can be met by internally generated funds. So it should vary across time, depending on profits and whatnot, revenues. Borrowing safe, what I mean by that is that firms also plan to cover part of normal investment with new borrowing, but it tries to restrain itself so it keeps this debt safe, so that it is almost risk-free. Of course, this doesn't happen all the time, and since target dividend payout ratios are sticky, that they tend to not change too much, maybe that changed today practically, but at the time at least, and investment opportunities tend to fluctuate relative to cash flows, the firm will have to, from time to time, borrow less safely. This is the final sort of point which Myers and Maslov try to make. It's been a pleasure. One more slide. Finally, the contribution, of course, the contribution this paper makes. So it is essentially a summary about these 2 branches of corporate finance literature. What is really good about it is that it's a summary that tries to structure this puzzle and tries to answer the question of the capital structure puzzle. I think it is invaluable for process and progress of research, because it is only through papers like these in which academia and academics can orient themselves towards the answer to be critical once more towards what has been done and what has yet to be done. Let's see. Uh, like he does this through seeing problems of both of these branches and proposes further research directions. Most notably, he sees the third proposition, which I talked about in the last video, I believe, on informational asymmetries and essentially agency cost as sort of fill in the gap contribution to pecking order theory. All right. Finally, it's been a pleasure making this video. I hope you have taken something that you have understood, and I am welcoming any criticism. Try to be constructive, I suppose. You can find me at f.ritchie@utrechtuniversity.nl. Thank you for watching.